Hey there! Before we jump into this deep dive on Hedera, stablecoins, and the massive shift happening in the world of finance, don't forget to like this video, subscribe to the channel, and drop a comment about what you think the future of money looks like. Your engagement really helps push these conversations further, and trust me, this is one conversation you don't want to miss. Alright, let's get into it. Why finance is changing. The financial system we've been using for decades is showing cracks. Banks settle payments over legacy networks like SWIFT that were built in the 1970s. Moving money internationally can take days, and the fees eat into every transaction. Meanwhile, technology outside of traditional banking has leaped forward. We can send a text instantly across the globe. We can stream movies in real time. We can FaceTime someone in another continent with zero lag. But money still crawls. This mismatch has created the perfect storm. On one side, you have central banks and governments realizing they need to modernize. On the other, you have crypto innovators building entirely new rails for value transfer. And in the middle sits Hedera, a network designed not to replace the system, but to upgrade it in ways that governments, institutions, and enterprises can actually adopt. Think of it this way. If Bitcoin is the wild pioneer settling uncharted land, Hedera is the architect building a modern city on top of it, complete with roads, utilities, and governance. But before we go too deep into Hedera itself, we need to understand the two big forces shaping finance today: stablecoins and tokenized real-world assets, RWAs. Stablecoins, the digital dollar that actually works. Stablecoins are digital tokens pegged to real-world assets, usually the US dollar. Instead of wild crypto volatility, they aim to provide the stability of fiat with the speed and programmability of blockchain. And right now, they're exploding in usage. USDT, Tether, and USDC, Circle, together represent hundreds of billions of dollars in daily settlement volume. For people in emerging economies facing inflation, stablecoins are lifelines. For institutions, they're programmable money that can integrate into DeFi, payments, and even payroll. Here's the kicker. When tokenized collateral grows, stablecoin usage on Hedera should grow too. Why? Because Hedera provides the speed, low fees, and finality that stablecoin issuers and users crave. Imagine moving millions of dollars in stablecoins across borders in seconds, with fees less than a cent. That's what Hedera enables. This creates what we call real flow liquidity. Not speculative crypto liquidity, but actual people and businesses using stablecoins for payments, settlements, and commerce. The more that happens, the more attractive Hedera becomes to market makers, exchanges, and liquidity providers. So stablecoins aren't just about digital money. They're about unlocking an entirely new layer of global liquidity. And Hedera is positioning itself to capture that wave. Now, let's talk about tokenization. This is where things get really interesting. Tokenization means taking real-world assets, stocks, bonds, real estate, commodities, even carbon credits, and representing them as tokens on a blockchain. Instead of dealing with clunky paperwork, settlement delays, and fragmented systems, everything can be traded digitally, instantly, and securely. We're already seeing massive moves here. BlackRock, the world's largest asset manager, has launched tokenized fund pilots. JP Morgan is experimenting with tokenized collateral for institutional settlement. Even central banks are exploring tokenized bonds. The implications are huge. Every single asset you know today, stocks, treasuries, real estate, could eventually live on-chain. And the platforms that can handle regulated, compliant tokenization at scale will win. That's where Hedera comes in. Its governance model and enterprise partnerships make it a natural fit for tokenization. Unlike some blockchains that struggle with compliance, Hedera is designed from the ground up to support real-world integration. It's fast, it's fair, and it's governed by a council of global enterprises. Now, combine tokenized RWAs with stablecoins, and you get a powerful mix. Collateral flows increase. Stablecoin usage grows. Market makers jump in. And suddenly, Hedera isn't just a blockchain project. It's part of the backbone of the next-generation financial system. One of the reasons Hedera is so interesting is its alignment with policy trends. Governments and central banks aren't ignoring tokenization anymore. They're leaning into it. Take the European Union, for example. The EU's MiCA regulation provides a framework for digital assets, stablecoins, and tokenized instruments. The US is still figuring out its regulatory approach, but even there, the Treasury, SEC, and Federal Reserve are actively studying tokenized settlements. In Asia, countries like Singapore and Japan are piloting tokenized government bonds. By leading regulated pilots and building bridges with governments, Hedera positions itself as a preferred settlement network. Institutions don't want to gamble on chains that regulators might crack down on tomorrow. They want safe, compliant infrastructure, and that's Hedera's angle. So while crypto purists might chase decentralization at all costs, Hedera plays the long game. Work with the system, not against it. That may not excite hardcore anarchists, but it's exactly what enterprises and regulators are looking for. Of course, nothing in finance is bulletproof. Hedera has opportunities, but also risks. Let's break them down. Regulatory shifts. A single new rule tomorrow could alter the economics of tokenized investing. Governments move slow, but when they move, they can reshape markets overnight. If stablecoins or tokenized assets face sudden restrictions, networks like Hedera will have to adapt fast. Multi-chain complexity. The future won't be one chain to rule them all. Assets, collateral, and post-trade systems will span multiple chains. That introduces complexity and error risk. Hedera has to make sure its interoperability tools are strong enough to keep up. Governance critique. Crypto purists already call Hedera too permissioned or too enterprise-aligned. The cultural gap is real. To some in crypto, Hedera feels like the corporate chain, which makes adoption among grassroots communities slower. Bridging that gap will be key for long-term relevance. Here's the part that a lot of people overlook. Liquidity creates more liquidity. When collateral flows onto a network like Hedera, it doesn't just sit there. It moves, it trades, creates demand for stablecoins. And every time stablecoins move, they attract liquidity providers and market makers. This creates a flywheel effect. More tokenized assets require stablecoins for settlement. More stablecoin usage attracts liquidity providers. More liquidity providers reduce spreads and improve efficiency. Better efficiency encourages even more tokenization. It's a feedback loop. And once that flywheel starts spinning, it becomes very hard to stop. This is exactly what happened with decentralized finance on Ethereum. At first, there were just a handful of lending protocols. But as liquidity pooled, more protocols popped up, more traders joined, and suddenly DeFi was handling tens of billions of dollars. Now imagine that same flywheel, but instead of just crypto assets, we're talking about US treasuries, corporate bonds, real estate, commodities, and equities. That's not billions, that's trillions. And if Hedera can capture even a fraction of that flow, it cements itself as one of the core settlement layers of global finance. One of the biggest differentiators for Hedera is its governance model. Instead of being run by anonymous validators or speculative whales, Hedera is governed by a council of global enterprises and organizations. We're talking Google, IBM, Boeing, LG, DBS Bank, Standard Bank, Ubisoft, and others. These aren't small players. These are some of the largest corporations on Earth, across industries from tech to finance to logistics. This matters for two reasons. Legitimacy. When a government regulator or Fortune 500 company looks at Hedera, they see familiar names. That reduces friction for adoption. Stability. Council members rotate, vote on upgrades, and prevent the network from being hijacked by a handful of actors. That's critical when you're settling real-world assets worth billions. Compare this to some other chains that suffer from governance drama, forks, or validator cartels. Institutions don't want that risk. They want predictability, and Hedera's council delivers it. Does that make Hedera less pure than something like Bitcoin? Sure. But it makes it more usable for the people actually running the financial system. And that's the trade-off that matters in the real world. In 2023, BlackRock launched a tokenized fund on Ethereum in partnership with JP Morgan. They used tokenized collateral for institutional trading. That's the world's biggest asset manager dipping its toes in tokenization. The Monetary Authority of Singapore, MAS, has been running pilots with global banks on tokenized government bonds, FX, and repo transactions. Some of the world's largest institutions are testing settlement on-chain. HSBC recently launched tokenized gold for trading, making it easier for investors to access physical commodities digitally. On Hedera itself, we've seen use cases like carbon credits being tokenized for transparent, auditable trading. This aligns perfectly with global ESG and sustainability trends. Every one of these pilots is a proof point. They show that tokenization isn't a maybe someday idea. It's already being adopted, and scaling up is just a matter of time. Let's circle back to stablecoins for a second, because this is the real moneymaker. Here's the simple truth. Every tokenized asset needs a stable settlement currency. You can't tokenize bonds or stocks and then settle them in volatile crypto. It doesn't work. That's why USDC, USDT, and other stablecoins are so critical. They're the glue that holds tokenization together. And Hedera is already home to USDC on its network. With its insanely low fees and near-instant settlement, Hedera is one of the best places for high-volume stablecoin flows. Imagine a world where a bank in Singapore settles a bond trade with a bank in New York using USDC on Hedera. A logistics company pays suppliers in tokenized stablecoins instantly across borders. A fintech app in Africa uses Hedera-based stablecoins for everyday microtransactions. That's not just speculation. Those are real-world use cases that align perfectly with Hedera's design. And the kicker? Once stablecoin liquidity flows in, DeFi protocols can flourish on top of Hedera. Lending, borrowing, trading, derivatives, all powered by stable, high-speed settlement. We can't talk about the future of money without talking about CBDCs, central bank digital currencies. Across the globe, central banks are piloting digital versions of their fiat currencies. China already has its digital yuan. The EU is working on a digital euro. Nigeria launched the naira. Even the US is studying a digital dollar. Now, whether you love or hate CBDCs, they're coming. And the infrastructure they're built on matters. Hedera may not directly issue CBDCs, but it can absolutely provide the settlement rails for them. Governments may not want to build from scratch. They'll partner with networks that are already fast, secure, and policy-friendly. And with its governance council, Hedera is positioned as a trustworthy option. It's not some anonymous chain run by unknown miners. It's backed by recognizable, credible institutions. This makes Hedera a likely candidate to host interoperability layers for CBDCs, letting different digital currencies settle and interact across borders. That's a multi-trillion-dollar opportunity. Now, let's address the elephant in the room. Crypto culture does not always love Hedera. If you spend time on Twitter or Reddit, you'll see Bitcoin maxis and Ethereum diehards dismiss Hedera as too corporate or not real crypto. They see the governance council and think it's just a centralized database. But here's the thing. Institutions don't care about purity tests. They care about functionality, compliance, and stability. For retail investors, crypto was about freedom from banks. For institutions, crypto is about upgrading their systems without losing control. And those two cultures will always clash. The question is, who's going to onboard trillions of dollars first? The anarchist side of crypto? Or the regulated, enterprise-aligned side? The answer seems clear. And Hedera is playing on the winning side of that cultural divide. As bullish as this all sounds, there's one risk we have to keep in mind. Fragmentation. The future of tokenization will not be one chain to rule them all. Different assets, different institutions, and different geographies will likely use different networks. Ethereum, Polygon, Hedera, Avalanche, private chains, you name it. This creates two risks. Liquidity fragmentation. If liquidity is split across 10 chains, efficiency drops. Market makers have to manage multiple pools, and arbitrage gets messy. Interoperability failures. If bridges between chains fail or get hacked, the whole system loses trust. And we've already seen billions lost in bridge hacks. Hedera's challenge will be proving it can connect seamlessly to this multi-chain world. Its interoperability strategy, through standards, partnerships, and trusted integrations, will make or break its long-term relevance. Alright, let's talk about the elephant in the room. For all the innovation and promise, no blockchain, not even Hedera, is bulletproof. Governance, regulation, and culture all matter. and how Hedera navigates these waters could define its future. Hedera's governance model is unique in the crypto space. Instead of anonymous miners or whales controlling the network, it's governed by a council of global enterprises, universities, and institutions. Think Google, IBM, Boeing, LG, Standard Bank, UCL, and more. Each member runs a node, votes on upgrades, and has equal say. No single company or entity can dominate. This model gives Hedera credibility with enterprises and governments. It feels stable, regulated, and trustworthy compared to more chaotic crypto ecosystems. But let's be honest, not everyone loves it. Purists argue it's too permissioned, too corporate. The crypto ethos has always been about decentralization and freedom from institutions. So Hedera walks a fine line, balancing enterprise appeal with crypto credibility. Regulatory risks. Now onto the regulators. Tokenization, stablecoins, and digital assets are all under heavy scrutiny worldwide. In the US, the SEC and CFTC have taken aim at numerous crypto projects. In Europe, the MiCA framework is rolling out to regulate stablecoins and crypto service providers. In Asia, countries like Singapore and Japan are crafting pro-tokenization policies. Hedera's strategy? Work with regulators, not against them. By leading pilots with banks and governments, Hedera positions itself as the safe pair of hands. But make no mistake, one sweeping regulation could still change everything overnight. A new law could reshape how stablecoins work, how tokenized bonds are issued, or how cross-border settlement happens. Multi-chain complexity. Here's another challenge. We don't live in a one-chain world. Assets, collateral, and post-trade processes are increasingly spanning multiple blockchains. For example, a bond might be issued on Ethereum, used as collateral on Hedera, and settled via a central bank's private ledger. That's a lot of moving parts. The risk, complexity, and errors. Bridges between chains have historically been weak spots, often hacked for hundreds of millions of dollars. Hedera needs to prove it can handle interoperability securely, or risk being sidelined in a fragmented ecosystem. Cultural critique. And let's not forget culture. In crypto, culture is everything. Bitcoin has its hardcore believers. Ethereum has its builders. Hedera is still carving out its identity. To some, it's the enterprise chain, safe, efficient, but maybe a little boring. To others, it's a sleeping giant that could quietly take over once the dust settles. The challenge is bridging the cultural gap. Can Hedera inspire grassroots developers and creators while still courting governments and corporations? That balance could define whether it becomes the default global settlement layer or just another niche chain. Okay, let's zoom in deeper on that multi-chain point. Because in 2025, no blockchain is an island. We're heading toward a world where multiple networks coexist. Public, private, permissionless, permissioned. And Hedera's role in this ecosystem is critical. If Hedera can position itself as the bridge between worlds, it wins big. Imagine this, a tokenized bond issued on Ethereum, used as collateral on Hedera, settled via a CBDC running on a central bank's private ledger. That's powerful. But to make it happen, interoperability must be seamless, secure, and scalable. Hedera's HTS, Hedera Token Service, and HIP standards are designed to help here. Plus, with its governing council spanning multiple industries, it has the partnerships to push for real-world interoperability. But here's the flip side. If tokenization fragments across dozens of blockchains, liquidity gets diluted. Market makers won't know where to go. Enterprises might hesitate to commit. Complexity could slow adoption. So Hedera's challenge is clear. Not just to be part of the multi-chain world, but to become a hub in it. A trusted settlement layer that ties everything together. So where does all this lead? Let's paint a picture of the next decade. By 2030, most assets could be tokenized. Stocks, bonds, real estate, commodities, carbon credits, even loyalty points and intellectual property. BlackRock, Citi, JP Morgan, and other giants are already preparing for this. The infrastructure is being built now. In that world, liquidity needs to flow 24/7 across borders. Settlement needs to be instant, final, and cheap. And networks need to be trusted by both regulators and enterprises. Hedera checks those boxes. Hedera as the neutral layer. Think of Hedera as the neutral settlement layer. Not run by one company, not controlled by a government, but governed by a council of global stakeholders. Could be the Switzerland of tokenized finance, trusted, neutral, efficient. If Hedera plays its cards right, it could be the rails on which trillions of dollars move daily. That's not hype, that's the logical outcome of tokenization at scale. And don't forget the sustainability angle. As climate goals tighten worldwide, green infrastructure will win out. Hedera's proof-of-stake, low-energy model, combined with its live carbon offset reporting, gives it a competitive edge. When enterprises and governments choose networks, sustainability will matter. Alright, let's bring this home. We've talked about stablecoins, tokenized assets, policy alignment, enterprise adoption, risks, governance, multi-chain complexity, and the future of finance. And through it all, one thing is clear: Hedera is positioning itself not just as another blockchain, but as the backbone of tokenized finance. It's not the loudest chain. It doesn't have the biggest meme community, but it has partnerships, governance, efficiency, and credibility. And that combination could make it the default network for the tokenized world. The next few years will be critical. Regulation, culture, and technology will all play their roles. But if stablecoin usage grows, if tokenized collateral takes off, and if enterprises keep building, Hedera could be at the center of it all. Now, let's not sugarcoat it. Risks exist. Regulation could shift. Multi-chain complexity could cause hiccups. Cultural critiques could hold it back. But if Hedera overcomes these, the upside is enormous. So what do you think? Could Hedera really become the backbone of tokenized finance? Or is it destined to remain the quiet achiever while other chains grab headlines? Drop your thoughts in the comments. I'd love to hear your take. And if you enjoyed this deep dive, don't forget to hit that like button, subscribe, and share this video with a friend who's into crypto or finance. It really helps the channel grow and keeps me making content like this for you. Thanks for sticking with me on this marathon deep dive. The future of finance is being built right now, and Hedera just might be the settlement layer we've all been waiting for.